Hey there, everyone. Today on the final bar, interest rates higher, stocks lower as the S&P once again tests neckline support at 4350. Earnings season kicking off this week, really starting tomorrow. We have airlines and banks to talk about. We'll review all the charts to help you get prepared for this next earnings season. Chris Verrone of Strategas is going to be joining us from New York. Is this recent downtrend in stocks just the beginning of Q4 weakness? Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the action in the markets using the best practices of technical analysis. These are uncertain times. There are a lot of different narratives to follow, a lot of different potential catalysts in the markets. We have the dollar, interest rates, commodities, crude oil, geopolitical events, certainly a lot of risks involved in everything I just said. And on top of all of that, the natural push and pull, the fear versus greed, the normal changing of hands of shares in the equity markets that causes things to move. Sometimes events in the markets are driven by macroeconomic conditions. Sometimes they're driven by more liquidity-driven conditions, like we've seen in a 2021 bull market, for example. Sometimes it's just sentiment and how it shifts and whether people get excited or nervous about different headlines and different news flow and the prospects of what may come next. Technical analysis I found is a really effective way of really measuring the pulse of the market, really focusing on the sentiment, how those sentiment conditions can evolve, and really focusing on the evidence that the markets provide back to us. I've mentioned some of the wildlife we have here in the Pacific Northwest. We had a bear break into our backyard actually twice in the last week. Again, that's our third bear incident so far in the last 4 weeks. I don't know what that means for the market, but we don't have any bulls breaking into our backyard. I'll leave it at that. We are taking steps to try to minimize the bear carnage. But let's get to the market recap and focus on what happened with the markets today. Before we get to the charts, we want to start with a poll question that we asked you recently. And don't forget to follow us on the socials. Make sure you subscribe to our YouTube channel. You won't miss the next question. We asked you guys recently, will gold make a new all-time high? That would put it over $2,100 an ounce or so before the end of this year, before the end of 2023, which is now only, about 10 weeks away, which is crazy. That will be the end of 2023. Only about 1 in 3 say yes. 2 out of 3 say no. Let's bring up a chart of gold and actually just look at where things are at. And I haven't brought up this chart in a little while, and I can tell because my trend line is not particularly up to date, but look at this trend line, how beautifully it is tracking the highs here on gold. Now, when you do $GOLD on the stock charts platform, that's the continuous contract. So it's bringing gold prices in from the futures market and looking at the trends over time. You can see connecting the highs here over the last 6 months, just a really consistent downtrend, right, of lower highs. So what strikes me as we rally out of extremely oversold conditions here in early October is that I think you have to label this a counter-trend move, right, until proven otherwise. Now, why would I label this a counter-trend move, meaning it is a move away from the larger trend, which is still down, because we're still below this trend line, so we're making a clear pattern of lower highs. This Fibonacci level around 1900, that was support in June. We kind of retested that in August again. We broke down through that level. So until we get back above that level, right, how good things are really, or how good are things really evolving? Finally, we're below the 200-day moving average. We actually tested that a number of times here in August and September and now breaking down. So on a rally, right, do we get back above the 200-day? I think a chart like gold, you start to think about a much higher likelihood of a retest or a move to all-time highs once we can get over that first gain, right? To have a 50% gain, you first have to have that 5% gain, right? And then a 10% gain. So thinking about some of the shorter-term objectives and what you would need to see to unlock the possibility of achieving higher objectives. That's kind of the general way that a technical analyst, in my experience, is wired. Thinking about levels that tell you something is changing. And for me, it's sort of in that 1930 to 1950 range, which would get us above this cluster of resistance and these well-established levels of support from previously. Also, the RSI has to get a lot better than it is, still below 50, even with the counter-trend bounce that we've seen. Let's check in on the rest of the markets and see how things played out. A lot of red on page 1 here because the S&P, the NASDAQ, the Dow all in the red. The S&P finishing just slightly below 4350, and that is a big red or pink line. I forget. I think it's reddish on my chart of the S&P, which we'll look at here in a moment. That's the neckline of that Head and Shoulders top. I saw a friend to Stock Charts, Tom McClellan, a longtime Stock Charts contributor, posting the Head and Shoulders pattern we've been talking about just in last day. And again, I think that's a pretty clear pattern of distribution, that lower high, that breakdown. But now this week, we've actually bounced back above that neckline. As of today, that's still in play. We're kind of right back at that point. So I think above or below 43.50 is kind of a key level certainly to watch. The NASDAQ about the same, down about 0.6% from yesterday's close. Mid caps and small caps a lot worse. About a triple decline of the S&P when you get down to the small and mid cap indexes, both down about 1.9% from yesterday's close. About triple the down move versus today's down 0.6 for the S&P 500. The only green on the front page is the VIX. The VIX pushing back up. It was nearing that 16 level, now pushing back up towards 17. And, again, back of the envelope, VIX above 20, in my opinion, would be sort of a major red flag, because you spike above a VIX level of 20 when investors are starting to get nervous, when they're getting anxious, and that anxiety, that cautionary feel is reflected in increased volatility because people are starting to panic a little bit and make some quicker changes. That's usually what causes volatility to spike during a bearish phase. And again, keep an eye on that VIX level to see if and when, probably more when than if, we spike above that 20 level. Interest rates pushing higher basically across the board, 5, 10-year, 30-year points all higher from yesterday, about 120 basis points, we'll call it, on the 10-year yield, which means the 10-year to 471. You can see the long bond yield just below 4.9%. 5-year yield similar to the 10-year yield around 4.7%. So, that prospect of rising rates and what that means as we had the latest inflation data come out before the open today, really weighing on stocks here earlier. Higher rates in general, not a great sign. The TLT down almost 3% today, and that was one of those charts that we looked at just to show the trend, that breakdown in bond prices and how that's evolved over time. The dollar spiking back higher. We had a great conversation yesterday with Adam Turnquist. He mentioned dollar strength and what that might mean. I think that was a really good point that he made. If you missed that interview, make sure you watch our show from yesterday here on our YouTube channel. Commodities mostly in the red. Not a horrible day, but GLD, the gold ETF, down about 0.3%. Silver a little more, down 1.1%. Crude oil in the form of the USO was down about 0.33%, but energy actually held up there just fine today. Looking at cryptocurrencies, all in the red, not severe down days. You can see Ether prices, probably the worst, down about 2.2%. Bitcoin down about 0.5%. Ether is actually getting near that 1,500 levels, just about 1,530. Bitcoin around 26,700, we'll call it. Finally, looking at sectors, very few of the 11 S&P sectors finishing in positive territory. Energy and technology just slightly above the zero level, followed by financials, and that's an important one. We'll look at the hopefully the chart of the XLF if we have time. Earnings season really getting started here tomorrow going into next week. The next couple of weeks we'll be talking about a lot of earnings charts, stocks and how they are trading leading up to an earnings announcement, coming after. Usually have a lot of gaps to try to think about and what that might mean. Really starts in earnest tomorrow with Citigroup and JPMorgan, Wells Fargo, if I remember right, a number of financial institutions all reporting before the open tomorrow. On the downside, some of the defensive sectors at the bottom here, utilities down 1.5%, real estate down 1.3%, materials there in the middle down 1.5% as well. Let's go to a daily chart of the S&P 500, just check in on where we're at. And I mentioned in the introduction how we were once again testing that neckline support. And here's what I mean, right? If you take a step back from your monitor, and if you can literally get out of your chair, wherever you're at, and take a step back, just think about what the overall shape of this market is. It's a clear rotation, in my opinion, for now, from an accumulation phase, really going into the July peak, to more of a distribution phase. And that distribution phase is marked by lower highs and lower lows, which is the pattern that persists through today. What's interesting is we are nearing the 50-day moving average. Today, a bit of a distribution day, kind of a bearish engulfing pattern of sorts. Not an ideal one, but I think technically qualifies as the S&P getting back to that neckline. 4350 is right around where this red line is, and that's connecting the lows from June and August. And those are important because that's the neckline, the interim lows, with this head and shoulders pattern that, again, I think many have recognized for good reason. It almost jumps off the screen at you. We broke down there in mid-September, and if you measure the height of this pattern, about 6%, you assume a similar breakdown from that neckline. That would give you a downside objective around 40.80, 40.70, 40.80, depending on how you measure the height of the pattern, what kind of scale you're using, that kind of thing. So we also broke below this trend line using the October low and the March low. That lined up to the breakdown we had right about that same time. Now we've bounced back just slightly above the neckline. We've bounced above that trend line, which of course puts us in this weird limbo phase. We're not really pounding higher at the moment, but we've bounced back above some of these key levels. So I'm certainly paying attention to see if 43.50 will hold. My overall long line in the sand that we've mentioned is that 4,200 level, and that comprises a Fibonacci support level, that comprises the 200-day moving average, which I think is a reasonable place to look for potential support. We've bounced off the 200-day, which honestly, if you're bullish, you probably feel validated that we're bouncing off of a support level. If you're bearish, which I would describe myself as more bearish at the moment about the overall structure that we've seen and the breadth conditions, you see this as a very validating bounce off of a key support level. That's what usually happens when you hit the 200-day. The difference is what happens next. And if the bear case is true, we probably break down below 4,200 and start to identify some further downside support. For now, it looks like that could happen in October, which is when a lot of major market bottoms happen. And again, we have a great guest today, Chris Verrone. I plan to ask him a lot of questions about some of the things we just talked about and some other inputs as well. Just to finish off our market recap, here's what I call the newer Dow theory, or the new Dow theory. Dow theory is looking, Charles Dow's original work looking at the Dow Industrials and the Dow Transports. It's a bit of an antiquated set of indexes, to be honest, when you think about the economy in 2023 versus like 1923, kind of a different set of things we may want to look at. So this is using an equal-weighted S&P 500 and an equal-weighted NASDAQ 100. And the question is, where are they at, right? Are they making new highs? Are they confirming each other, which is called a bull confirmed signal? Are we getting some sort of disagreement like we saw at the end of 2021 with one of these indexes making a new high and the other one not? It's called a bearish non-confirmation. Do we see the opposite? Do we see one of them making a new low and the other one not making a new low, which would be a bullish non-confirmation? Or do we get the condition we have right now, which I would say both of them breaking to a new swing low? And both of these undercut their August lows. Both of them break below trendline support, which they clearly have. I see this as telling me that the primary trend in terms of the time frame that I'm looking at this point is more in distribution. It doesn't say we're going to zero. It doesn't say the S&P is going to go to 2,000 or something like that. I mean, it could, but it's not on this chart alone telling you that. It's just telling you the conditions right now are in distribution, which means you're looking for signs of something different. And that's what I would argue we're not necessarily seeing yet. What's funny, though, is you can see some interesting patterns on a lot of different charts here. Let's look at the semiconductor space, because I would argue, one of the sort of ways to think about this market is maybe like a kind of a bull flag pattern. And a bull flag pattern is basically where you have a big run higher, you then have a pullback of lower highs and lower lows, and ideally it's a parallel channel, kind of a short-term downtrend. And the exit of that bull flag is when you get above the upper boundary, which we're kind of trying to do today. Didn't quite do it, but through the remainder of this week, going into Friday into next week, my question would be, do semiconductors break out of that, what we might call a bull flag pattern? And if so, that suggests a lot more upside for semiconductors. So what's so interesting is, even though I would say there are a lot of signs of distribution, there are a lot of question marks in terms of the overall trend, some of the charts like semiconductors actually look pretty decent if they can push a little bit above current levels. The RSI is right at 60 for the semiconductor ETF, which is, as we've talked about, that's kind of the upper end of the range if we're in a bearish phase. Usually don't get much above there. So we're kind of right at that key decision point. The question is, do we power to a new swing high? Do we get above the high from late August, early September? Unclear at this point. Another group to think about, home builders. Home builders have felt quite a bit of pain here recently. This is the ITB, which is one of the two sort of home builder, home construction ETFs. The ITB and the XHB are the two that I like to look at. A little different in terms of the weightings and in terms of what types of stocks are included. But ITB is the one that I sort of my go-to list to really think about the home builder space overall. Now, if you look, you have this rally off of the June low, a secondary low there in September, October, then this nice consistent uptrend. Look at how many times home builders pulled back to an ascending 50-day moving average until finally changing that in July into August. We've now put in a pattern of lower highs and lower lows, and now we're testing the 200-day moving average. Today we closed just slightly below the 200-day. That's after bouncing above it not too long ago. Now, what's interesting about this chart is if we then take it a little step further and apply a Fibonacci analysis, I'm going to go from sort of this high here in July down to this low in October, and if you look, we're kind of right at that 38.2% level. Right? Somebody's just extending this Fibonacci, the 61.8% line. You can see how we've sort of hit that level. So we're hitting the 200-day moving average. We're hitting a Fibonacci support level. It's kind of right at that point. Again, right at kind of that key moment where if this is going to hold, right, if home builders are just a tactical pullback within a bullish phase, you'd kind of expect it to not get much further down from where we're at right now. It's kind of that point where if we get below here, I think you have to start questioning whether this is still bullish at all and think more about downside objectives. And again, we're kind of right there. We traded down there on an intraday basis. The ITB was down another 4.6% just today. Now, I mentioned earnings season, and just to kind of get you thinking along those lines, we haven't talked about earnings too much because sort of between the main earnings season, it's kind of random consumer discretionary names, but not super earnings heavy. We're kind of entering into the next couple of weeks, fourth quarter earnings season. We start to hear about what sort of reports and what sort of outlook these companies are dealing with, how a stronger dollar could impact earnings prospects, which is something Adam Turnquist from LPL Financial talked about yesterday. How are these companies pricing in the impact of crude oil prices and the uncertainty surrounding the commodity space, just inflation and where it's at and what that might mean? So a lot of clarity, hopefully, maybe comes from the next couple of weeks with a lot of earnings discussions. Let's think about the charts of some of these. Delta actually reported today down about 2.3%, kind of a telling day because we opened around 37. We actually closed down around 35. So quite a message, I think, that the market was sending through the course of the trading day today. An initial gap higher, but then as investors had a chance to sort of digest things through the course of the day, finished down about 2.3%. The airline space in general has had some struggles recently, and it's not just Delta. I mean, if you look at American Airlines testing a new 52-week low, I mean, not too far above there. Others as well really have given back a lot of those previous gains. Stronger oil prices certainly not helping the case here, but it's also just thinking about the technical conditions, the fact that these are now in pretty clear downtrends of lower highs and lower lows. Just to finish off the market recap, two charts to share with you, Citigroup and JPMorgan. What's interesting about both of these charts, different phases, right? So JPMorgan kind of coming off of a new high there in July. Citigroup a little more muted, right? Sort of testing the lower end of the range. Both of these stocks testing a descending 50-day moving average today. So you see Citigroup actually rallying right up to the 50-day for now. You can see JPMorgan, again, a different phase, but also testing that 50-day. Reporting before the open tomorrow, and I'd love to see if both of these stocks can actually use earnings as a catalyst to push to a new swing high. Then we can start to think about upside potential. The interesting thing about JPMorgan, you have a bit of a bullish divergence going into their earnings report. Lower lows in September into October, higher lows of momentum. That makes me think maybe we get the trend maybe turning higher, but we break to a new low, break below the 200-day. I would say all bets are off on a chart like JPM. That's it for our market recap. A lot of charts to talk about. Those are some of the ones that are top of mind for me as I'm looking at the charts and reviewing the evidence. We're going to bring on Chris Verrone here in a moment. Before we do so, a couple quick announcements. First off, we welcome your questions. Our chat is open here on our live show. You are welcome to use it as we broadcast. We may not get to those questions during the live broadcast, but we're watching and we're listening. We will hope to bring up some of those questions in future episodes as much as we can. We have a mailbag coming up tomorrow, so anything you throw in the chat, just put a comment below the chart or email us your question at thefinalbar@stockcharts.com. We'll answer some of those from the Final Bar mailbag on tomorrow's show. Also, as a reminder, we've had a lot of fun doing a live Q&A on our YouTube channel once a week. We're actually going to be incorporating that right into this show. So starting Monday, we will open up the chat. We will focus over there midway through the show, probably on Monday, and start answering questions live. So make sure you join us on Monday for that first live Q&A on the Final Bar. I want to welcome on today's guest, Chris Verrone. Chris is the head of technical and macro research at Strategas Research Partners, coming to us from New York. Chris, great to see you again. How have you been? Okay?
I'm doing great, Dave. Great to see you as well.
Chris, hold on just a second.
Can you hear me?
There we go. Yeah, Chris, how are you?
Great to see you, Dave. How's everything?
It's good. It's good. We were talking about before the show. I feel like there's an endless list of things we could talk about given the market conditions. It's an uncertain time for a lot of investors. When we're looking at the S&P 500, when you're looking at a chart of the S&P 500, what stands out to you? And overall, what is your perspective on stocks leading into this earnings season?
Yeah, it's a great question. And certainly we'll get some new information over the next week or so as the earnings start to come in. But I think about the last like 4 or 5 days, we've gotten a lot of questions from clients regarding does the reversal off Friday's payroll and some of the follow through we saw after the weekend, does it remind us of the reversal we got this time last year as we kind of put in that October 2022 low? And listen, I think certainly you need to respect when the market seems indifferent to bad news, and maybe Friday and Monday and Tuesday, there were some signs of that. But when I look at the breadth comparison from a year ago, what we got off that low, when you were coming off that October 2022 low, I think you had 5 or 6 or 7 days where advancers just overwhelmed decliners. It was as potent as you would want to expect or see off a low. And then you kind of juxtapose that to the last week or so. I think on Friday, breadth was maybe 2 to 1. On Monday, it was 1.5 to 1. The best we got, I think, was actually Tuesday. It was maybe 2.5 or 3 to 1. And we erased it all today. I think we're like -7 to 1 on the downside today. So we have yet to see that type of all clear escape velocity type breadth the last couple of days. I think it's an important distinction. And I would also just note maybe the other big difference from coming off last year's low versus today, discretionary was dominant coming off last year's low. And I know, like, when you look at Amazon or Tesla right now, the charts are good. They certainly are. But when you go stock by stock and start looking at consumer discretionary under the hood, I mean, it's graveyard, particularly when you go down the cap scale. So I don't think we have that endorsement from discretionary, nor do we have the breadth that looks like what I would expect to see off your traditional October low.
So it's what's so interesting is and I 100% agree with you. I can't disagree with you. We're entering into what some would argue the seasonally strongest part of the year, right? We often have an October low. November, December actually tend to be quite strong. How does seasonality fit into your thinking about the conditions going through the end of the year?
I certainly don't want to ignore it. I would say of all the tools and inputs, it is probably lower on my process or how I think about things. It's funny. Everyone always talks about the lows in October. You've also had highs in October. One of the big highs, October 9th of 2007, is one of the most meaningful highs. So, be a little bit careful with the seasonality. I always say that trend matters more than seasonality. And listen, the trend of the big 7 stocks, as we know, is largely up, and standing in front of that is probably silly. But we also can't ignore the deterioration that you've seen really sector by sector, stock by stock, particularly in some of the more cyclically oriented groups. So, it's almost difficult to have an index call here. I think it's far more appropriate to have a lot of different stock calls. I took a couple days off right around Labor Day, and I got away from the screens and didn't look at a chart for maybe 2 or 3 days. And I came back that Monday of Labor Day, and I looked at every single price in the world. And I wrote one note down to myself. I said, quote, if this is a bull market, what will a bear market look like? Because there's so many bear market charts out there, yet the index really has continued undeterred because of, as we know, some of these big weights. And listen, it still counts. S&P's up 15 or 16. It's up 22 off the low. NASDAQ's up 35 off the low. Those count just as much as anything. But it's been a very unusual first year off this low.
Yeah, it's so fascinating. I think that's a really good point, Chris. When you think about, I almost feel like the major benchmarks are a result of these individual names and really just the characteristics of the market. It's less about strength in stocks overall. The benchmarks are strong because of the strength of certain names that have a pretty good weight in the benchmark. One of the things I'd love to ask about, you mentioned the breadth conditions, certainly not shoot the lights out, recovery phase. Small caps have been a noteworthy non-participant, right, in the markets in 2023. We're looking at the Russell 2000 ETF. I mean, at best, it's a sideways market, right? I mean, at best, how much does a lack of participation in small caps fit into how you're viewing things here?
So I'll make 2 points, and then I'll say something probably controversial. First observation I'll just make is we. As we know, Russell 2000 is conceived in 1977. So we have about, let's call it 45 years worth of small cap data. We've actually built a series back about another 75 years. So I have about 100 years worth of a small cap index. I looked at small caps off of every major S&P low over the last 100 years. Today's the 1-year anniversary of the low. It's October 12th. Small caps are up 2% since that low. It would be more normal, Dave, if they were up 200%. Right. When you look at what you tend to get off of a low, 50, 60s. I think the median was something like 50 or 60% from small caps in the first year. They're up 2 here. The other place you can do that is with banks. Banks are down 20 in this first year off the October low. Only time in 100 years where bank stocks have been down. Now, I'm going to say something controversial. I think on the other side of whatever this is, there's actually a really potent or bullish small cap cycle that's ahead of us. I can't get there on the charts yet, but here's how I get there kind of hypothetically. For 13, 14 years, there was no interest rate that would put bad companies out of business. And you have a lot of companies in Russell too that are just zombies that only could have existed in this zero interest rate regime that dominated much of the last 15 years. So I think in a weird, almost perverse way, a 5% 10-year yield is going to clean up this index. And we're going to get zeros in a lot of marginal stuff. I think what's very interesting is as the big techs have rallied again over the last number of weeks, the real marginal techs, the real small cap ones, the ones with no earnings, haven't worked at all. The market's telling you that something's going on here. So I think looking down the road, we're going to clean up what is a very, very dirty index under the surface. And on the other side of this, I actually suspect you will get a small cap cycle. I couldn't tell you when that is. I don't know if it's 6 months from now or 6 years from now, but I do think on the other side of whatever type of cycle this is, you get small caps on the other side.
Interesting set of points there. And certainly, I mean, the cycle for now has been weakness in small caps. I agree with you. You go under the hood and really go through the details. There's some questionable businesses in an index of small caps like that. Can we talk about interest rates for a moment? Obviously, the story, I mean, one of the big stories has been rising rates, the prospect of the Fed. Even today, we sort of have this, fluid situation of expectations for rates. Do you see rates going higher materially from what we've seen so far, and how does that fit into your picture for risk assets?
What I find remarkable is I'd say the last 72 hours, almost every meeting I've been in, every conversation I've had, people are convinced, maybe until today, people were convinced that yields peaked on Friday. And I'm just, the trend is really potent. Are you that sure they've peaked? And that's always my thing. Like, what is the consensus? How is the consensus positioned? What is the message of the market? And how does news interact with all of this? And there's a lot of confidence out there that rates have peaked. There was also a lot of confidence a year ago that rates peaked, and they hadn't. So I think the market has to prove the bond bears wrong before I would be comfortable saying the long end has peaked. You could probably convince me with some charts that maybe some short rates are peaking around the world. German twos maybe are peaking here. US twos maybe starting to peak. But long rates, whether it's US 10s or German 10s or Italian 10s, I don't think we're there yet. I'm really struck by my colleague who Tatsone, looks at a lot of the kind of street forecasts. And we just ask, okay, where's the street positioned and what's the market saying? There are 48 Wall Street economists who submit yield forecasts to Bloomberg every week. Not one of them has the 10-year yield above 5% in the middle part of next year. That's like 20 basis points away. It could be there tomorrow. It's just very striking when really, really potent trends are ignored.
Right. That sounds like a pain trade of sorts to me, Chris. And I love that explanation. Thanks for all that detail behind there. Can we talk about a group like energy? This is one of the areas of the market that at points in 2023 has certainly been an area of strength. And in the third quarter, energy stocks sort of, really came back into their own. Pull back a little bit here. Do you see upside in names like DVN or Attempt or FANG trying to break out here? Do you see opportunity in a space like energy, or given the market conditions, do you hold off in an area like this until there's further evidence?
Well, I'd say I certainly see continued relative leadership from energy. It's funny that this group was so dominant for 2.5 years, let's call it mid-2020 through maybe January or February of this year. And then it took 4 or 5 months off and everyone forgot about it. And then I think the irony is you print 3% CPI on July 12th of 2023, and the exact opposite of Goldilocks happens. The energy stocks just totally reassert themselves. I think leadership sectors constantly evolve of what sub-industry is going to take the baton. And I find it really notable here. What's taking the baton right now in energy is natural gas oriented stocks. I mean, we had natural gas itself turned in our trend model maybe 2 weeks ago, but look at the setups in stuff like EQT or Southwestern or Range. I mean, these are high level consolidations, in many cases near multi-year highs, above 50s and 200s, quiet relative leadership in a market that I think is starved for leadership. I want to play with some chips in this space.
I love that. Strong relative leadership in a market that's starved for leadership. That's really well said, Chris. Talk to us. We just have time for maybe one more question. When you're thinking of the broader markets here, thinking about the S&P, we've talked about some of the levels to pay attention to, and we've mentioned 4,200, the 200-day moving average, kind of that first level that if we don't hold that, things could get worse from here. Is there a level or a signal that you would see, or is it something different, something like breadth conditions or interest rates that would tell you, okay, this is time to really get defensive? Because I feel like you could still make the argument this is still okay in a lot of ways. Where do you start to get more defensive than you are now?
Yeah, I think just the chart itself is not terrible by any means, and the trend has largely been up for the better part of the last 12 months. No debate there. I would say more important than a level, kind of evaluate the character of this market here. And this reversal and rally attempt off Friday's strong payroll number, I think it's been underwhelming under the surface, and it's been underwhelming from a leadership perspective. So I would say this move since last Friday may be a C plus in terms of a bounce, not an A. My suspicion or my sense is just from traveling around and talking to people every day, 4,200 to way too consensus as support. People I know who don't look at charts say 4,200 like it's gospel. My suspicion is it would have to be something lower than that. 40.50 is the midpoint, is the 50% midpoint from the low last year to the high. That number kind of has my interest here. I do think you should watch German DAX and French CAC here for clues. They've been leading S&P basically for the last year. I don't like the price action there over the last couple days. You tried to rally and then get just turned away at the 200 today, 50 now below the 200. I think we're going to get clues here. If S&P is really going to salvage itself and come out of this and make new highs, I suspect German DAX and French CAC would have to do something similar. So I'm looking there for some clues.
Chris, this was awesome. This was a lot of fun. Thanks for sharing some expertise and some insights with us. Stay safe, be well there in New York, travel well, and we'll talk to you again soon.
Great, Dave. Thank you.
That's Chris Verrone. Chris is the head of technical and macro research at Strategas Research Partners in New York. What a thoughtful strategist. Really knows his stuff, and it's been a pleasure to get to know Chris and his work over the years. And a lot of really good points there. I love that comment about energy, looking for strong relative performance in a market that is starved for strong relative. I think that's a really good way of thinking about where opportunities lie in a challenging market. The relative strength line so often is a really good way to focus in on what the market is telling you is worth your attention. Great take there by Chris Verrone at Strategas Research Partners. Folks, we've got to wrap the show and go to the 3 in 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I thought Chris's comments about leadership were really well taken. We didn't have a chance to get into some additional leadership themes, but I think that's a really, really good point. We talked before about just the narrowness of this rally. A lot of the mega cap stocks really driving a lot of the performance. I'm struck by how little of a rotation we've seen into one of the more defensive sectors, consumer staples, right? So while I would argue that the primary trend, in my opinion, is still down, right, as we make this pattern of lower lows and lower highs, I would also say we're not seeing climactically negative signs in utilities or REITs just ripping. Now, they've bounced a little bit, but the trend is really not to utilities yet. You're seeing consumer staples clearly underperforming consumer discretionary. On the top, we have the cap-weighted version of that ratio favoring the XLY over the last really year to date. You can see the same thing on the equal weighted version. It's just making a new swing high this week, new high for the year. So you're still seeing offense over defense in some of those measures that I traditionally use to gauge the overall risk conditions in the market. So it's still telling me risk on in some of this positioning. You're not seeing investors get as defensive as you might fear they are. Chart number 2, Hormel Foods. I love looking at charts like HRL, and I highlighted one yesterday. I forget what the name was. It was probably a different staple stock, I would imagine. But charts like this, I love to share and talk about because a big down move today, down 10%, that hurts. And if you hold this name, this is not a fun day to watch 10% of the value disappear in a snap of the fingers. But look at all the signals that you missed. If you're still holding it at 36. What happened to the failure to overcome resistance, the failure to get above the 200-day, the failure to hold support around 37, the fact that it's below two downward sloping moving averages, the fact that the momentum is clearly in the bearish phase for most of, if not all of 2023, the fact that it's been a chronic underperformer. So in a lot of ways, while today's move may have surprised you, the trend hopefully should not surprise you. And I think that's a lot of what we do when we analyze charts is just answer that first question, what is the trend? And then a change in the trend could surprise you, right? If we turn on a dime and rally off of a new low, that can be an interesting change. But the fact that we're down a lot in a trend that is clearly negative should not be a surprise. And I hope you have a trend follower hat that you have on many times during the trading day. I think it's going to serve you well. Finally, let's finish the day on a strong note. There are names that are breaking out. What so strikes me, I was asking Chris Verrone before the show about Eli Lilly, other names making new highs, because they're there, right? There are names breaking out, just as there are names like Hormel breaking down. Diamondback Energy, FANG, making a new high today, right? If you look at FANG, you can see a break above 160, gapping higher, just over 2.2%. This gets us above the recent resistance around 158. The momentum is strong but not excessive. The relative strength is there. So I think there are charts out there that are working. This isn't a condition where nothing's working. There are things that are actually performing quite well. Make sure you use the alert system on stock charts. Use our scanning engine aggressively and liberally in this sort of environment and focus on names that are performing well. I think that's going to give you potentially some good opportunities going forward. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close. We'll open the mailbag tomorrow. So if you have a question that's been on the top of your mind, make sure you email us your questions at thefinalbar@stockcharts.com. Special thank you to Chris Verrone of Strategas joining us from New York. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.